This is lecture 1 for week 13, and this lecture is still in topic 9. Last week I have covered half of topic 9, and today hopefully I can cover all the syllabus in topic 9. So this is the thing that you have seen last week. So last week I have explained about the basic element of the budget process. So the first thing that I have explained is, in this subsection I have explained about continuous budgeting. Okay, continuous budgeting is something like this. A business prepare budget continuously. The business always maintains a 12-month projection or budget into the future. So like if today is this month is June, so a business already has a budget of July 2021 to June 2022. When next month July is started, the business will prepare a budget that will cover from August 2021 to July 2022. So at all time, the business always has a 1 year budget. That is called continuous budgeting. Another practice is the business uses or can use zero-based budgeting. So zero-based budgeting, the business will have a budget prepared before a new year is started. Let's say this is year 2021. So before the year 2021 is started, the business prepare a budget for 1 year, January 2021 to December 2021. And then when the year 2021 is started, the business will use the budget. We'll use the budget, and then at the end of year 2021, the business will prepare a new budget for year 2022. So it is like when a new year is started, the business will start the budget with zero. So that is why it is called zero-based budgeting. Okay, so now you will see two types of budget. This is important. Businesses out there, most of them will have a budget, and then they can sometimes they use a type of budget called static budget. So see what is a static budget. A static budget shows the expected results of responsibility center for only one activity level. The budget does not change even if the activity of the business or the quantity of production changes. And then the second point here, a static budget is used by many service companies and for some admin functions of manufacturing companies. Okay. Remember the key point here, this budget is focusing on only one activity level or a number of quantity of production only. So let's see an example of a static budget. So this is an example of a static budget. This is, I don't know why this textbook uses an old example, but it's here. You can see the example is year 2008, now year 2021, but it is the same thing. Okay, so static budget. This is an example of static budget for a production department. For this production department, the department prepared budget for the next year. Then when the company prepare the budget, the department prepare the budget, the department uses static budget. So this is how the static budget looks like. The department lists all the expenses related to the department. Here there are 3 expenses: direct labor expense or cost, electricity expense or cost, and supervisor salaries cost. There are 3 costs. So the department lists the cost with the expected amount related to the cost. In this example, the direct labor is $40,000 or budgeted at $40,000. Electricity is budgeted at $5,000. Supervisor salaries is budgeted at $50,000 for the next year. And then the total department cost is budgeted at $60,000. So this is an example of a static budget. Remember the keyword, the static budget is prepared with focusing on only one production activity or production quantity. So when the department prepare this budget, it is expected that this will happen next year. Okay, there are strengths and weaknesses of this static budget. The strength of this static budget is, this budget is simple. All expenses are budgeted as fixed costs. See, the direct labor cost, the electricity, and the supervisor salaries are budgeted as fixed costs. Next year, this is the amount related to these 3 costs. But there is a weakness. The weakness is a static budget does not adjust for changes in revenues and expenses that occur as volume change. So the weakness or the problem is, the static budget make all the costs as fixed costs. But the thing is, sometimes when the department is actually doing the production, something unexpected happen. Maybe there is a natural disaster, so the production becomes lower than expected, or there is a sudden increase in demand for the product, so unexpectedly the production quantity is very high compared to the budget. So that is the problem. The budget does not adjust to the changes in the revenue and expenses and quantity of the production. The budget is fixed or static. That is not good, because when the budget is fixed, when something unexpected happen, you cannot compare the actual number and the budgeted number. Let's say this is the business, this is the budget, and then when the new year is started, the actual direct labor is 55,000. The budgeted direct labor is 40,000, but the actual direct labor cost is 55,000. When you compare the actual cost and the budgeted cost, then you will see that there is a 15,000 unfavorable. The actual cost is $15,000 higher compared to the direct labor cost. Let's say the increase in the labor cost is because of sudden increase in the demand for the product. So actually that is good, because when there is a sudden increase in demand for the product, the company will make more profit. But when you compare the actual number with this budgeted number, then you will say that the situation is unfavorable because the actual labor cost is higher compared to the budget. So that is the weakness of static budget. It does not change according to the changes in quantity of production or activity of production. Okay. Okay, another format of budget that is also used by many businesses out there is called flexible budget. We can say that flexible budget is the opposite of the static budget. See here, the first point, flexible budget show the expected results of a responsibility center for several activity levels. Static budget is focusing on one level of production or one a number of quantity of production only. But flexible budget is flexible. It shows the expected results of a department or business segment for several activity levels. A flexible budget is especially useful in estimating and controlling factory costs and operating expenses. So a flexible budget is better when you want to make comparison between actual cost and the budgeted cost. So this is an example of flexible budget. See here, the same department. So if the business uses flexible budget, you can see here, the first thing is when the department uses flexible budget, the department will show different budget for different level or quantity of production. See here, level 1 is unit of production 8,000 units, level 2 9,000 units, level 3 10,000 units. So that is the first thing about this budget. And also when a business or department uses flexible budget, the department or business has to divide the cost into variable cost and fixed cost. You can see here, the variable cost related to this department is first direct labor, and then second electricity. These are two variable costs. And also at the same time, the department has fixed costs. Electricity power or electricity cost has a fixed component. In this example, 1,000 every year. And then supervisor salaries cost is a fixed cost, 15,000 every year. I'm not sure every month or every year. Maybe every month. Maybe every month this data. Let's say we assume it is monthly data. So the total department cost is 60,000 if the production is 8,000 unit, and then budgeted cost is 65,500 if the production is 9,000 unit, and 71,000 cost if the production is 10,000 unit. So you can see this is a flexible budget. The budget shows different costs at different level of production or quantity of production. So this flexible budget has strength and weakness. The strength is flexible budgeting provide information needed to analyze the impact of volume changes on actual operating results. The good thing about this flexible budget is the budget will change if the production quantity of the department change. So it is good when you can compare the actual. You can make a good comparison between the actual number or the actual cost and the budgeted cost, because the budgeted cost will change when the quantity of production change. The weakness of flexible budget is it is a complex budget, a bit difficult to prepare, because flexible budget requires greater research into cost. The department has to identify how much from their costs are fixed and how much from their costs are variable. So you have seen in the flexible budget, the department has to divide the cost into variable cost and fixed cost. In the example that you have seen here, the cost, even though the department has to divide the cost into variable and fixed, these costs are simple. But if you have your own business or you work as a manager in a department, it is difficult to categorize costs into fixed costs and variable costs, because you have many costs. For one department, you have many costs, and also some costs are very difficult to calculate. How much from the total cost is fixed and how much from the total cost is variable. So remember, flexible budget is good because the number is can be adjusted according to the quantity of production. But the weakness of this budget is sometimes it is difficult to prepare, because the department or business has to categorize the cost and then to separate the cost in the budget. Okay, let's see. Then here there is like an example that show you flexible budget is better compared to static budget. So let's see. If Coulter manufacturing company assembly department spend 72,000 to produce 10,000 units, how much over or under budget would the department manager be using a static budget? And if the business using a flexible budget? Okay. You have seen the budget in the previous slide. So if the department actually spend 72,000 to produce 10,000 units, so how much is the over or under budget? Okay, if the business or if the department uses static budget, then you will see the difference is over budget 12,000. In the previous slide, you have seen that if the department use the static budget, the budget is the budgeted cost for the department is 60,000, and then the actual results for the department according to this sample situation is 72,000 cost for the department. So when you compare the actual results and the static budget total cost, then you will see that the difference is 12,000 over budget. Then you will say that the situation is not good. This kind of comparison is done when a manager do a controlling activity. If you are a manager in that department, this is one of the things that you will do. At the end of every month or every year, you will compare actual data and the budgeted data. Here the actual data is 72,000, the budgeted data is 60,000. The difference is over budget 12,000. Then you will say, if you use static budget, you will say that the situation is very bad. the department pay cost 12,000 higher compared to the budget. Okay, this is if you use the static budget. But if you use flexible budget, what will happen? Remember, flexible budget is a budget that can adjust or that will change when the quantity of production changes. So here in the flexible budget, if the department produces 10,000 units product, the budgeted cost is 71,000. You can check the previous slide. In the flexible budget, if the quantity of production is 10,000, then the budgeted cost is 71,000. The actual results in this sample situation is 72,000. So if the department uses a flexible budget and the department do the comparison between the actual results and the budgeted cost, then the difference is only 1,000 over budget. So this comparison is better. The conclusion that you can make from this comparison is better compared to if the department uses static budget. You can see in the previous slide, if the department uses static budget, the difference is 12,000, and then we can say that, oh, the department is very bad. But now when the department uses, or if the department uses flexible budget, then we can see clearly the difference is only 1,000. That is not bad. That is a very small difference between 72,000 and 71,000. Very small difference. So we can say that the department is still doing good. A small difference between the actual data and budgeted data is normal, because we cannot achieve 100% same budget and actual. No, a small difference, whether it is over budget or under budget, is acceptable. It is normal. I think this is not over budget. This is under budget, isn't it? The budget is 71,000. The actual result is 72,000. So it is under budget. Okay, but doesn't matter. It shows that the previous slide shows that if you have a business or a department, flexible budget is better compared to static budget, because it will change according to the quantity of production or activity of production. Okay, let's see here. This is like a sample question here. At the beginning of the period, the assembly department budgeted direct labor of 45,000 and supervisor salaries of 30,000 for 5,000 hours of production. The department actually completed 6 hours of production. Determine the budget for the department, assuming that it uses flexible budget. Okay, you are given two data: budgeted direct labor and supervisor salary. And then you are asked to calculate or prepare budgeted cost if the business uses flexible budget. So remember, what is the characteristic of flexible budget? First, the flexible budget can change when the quantity of production is changing. Second, when you prepare a flexible budget, you have to categorize the cost into into variable cost and fixed cost. So when you see this question, ask yourself, First, you know the quantity of production or production hours are 50,000, 5,000 hours and 6,000 hours. Second, there are two costs here. Which one? Budgeted direct labor cost 45,000. Is it a fixed cost or variable cost? Okay, remember this. Labor costs and material costs, direct labor costs and direct material costs are always variable costs. These two costs will change when the quantity of production is changing. Always remember that. And supervisor salary, most of the time, is a fixed cost. Because supervisor does not work or supervisors does not assemble product. Supervisors monitor workers. No matter how many units product is produced, the work of the supervisor is same. He monitors the workers. He does not involve in the production process. So most of the time, supervisor salaries is a fixed cost. So let's see how to prepare that. So see here. First, you have to adjust the direct labor hour to become 6,000 hours. In the question, the data is given for 5,000 hours. So now you prepare a budget for 6,000 hours. And then you have to divide the cost into fixed cost and variable cost. So like I said earlier, the variable cost, the direct labor cost is a variable cost. So $45,000 direct labor cost given in the question in the previous slide is related to 5,000 hours. So you have to divide the cost to calculate how much is the direct labor cost per hour. So the calculation you can see here, the star here, $45,000 divided by 5,000 hours, you will get that for every one direct labor hour, the cost is $9. So when you prepare the flexible budget, the direct labor cost is equal to 6,000 hours times $9 per hour. So the variable cost of direct labor equal to 54,000. The fixed cost, the supervisor salaries cost, is a fixed cost. So it will not change. Even if the quantity of production is changing. So the supervisor salaries cost is fixed at 30,000. So the department cost, expected or budgeted department cost for 6,000 hours of production is $84,000. Okay, so this is like the end of this topic. I just want to introduce you to one budget that is very typical and very useful, and most businesses will use this budget. Very important. This budget is called master budget for a manufacturing business. Okay. Okay, master budget is like this. Master budget is the most important budget that a manufacturing business should have. The budget will cover everything related to the production or manufacturing business. So you can see here, the master budget will start with a sales budget. When a manufacturing business want to prepare a master budget, this budget is very useful. It helps the business to do planning, implementing and controlling activities. Implementation and controlling activities, very helpful, this budget. So you see here, the budget covers almost everything related to the manufacturing business. It is started with preparing sales budget. When a business want to prepare a master budget, the business has to prepare the sales budget first. The logic is like this. The higher the sales of a business, of a manufacturing business, the higher all the activities in the business. If the sales is low, then all activities in the business will become low. If the sales is very high, then every activity in the business will become high, will increase. So that's why if you work in a manufacturing business and then you have to prepare a master budget, remember you have to start preparing the budget by preparing the sales budget first. Okay, see here at the top, or the first process in preparing master budget is to prepare sales budget. After that, the business will prepare production budget. The production budget is prepared after the sales budget because the production quantity is or has to be set according to the sales quantity. If you have a business and then you think that in your sales budget, you think that next year you will sell 100,000 unit of product. So after you got that number, you can prepare the sales budget and then you can prepare the production budget. So if let's say your business can sell 100,000 unit product next year, so when you prepare the production budget, how much do you think your business has to produce? So the thing is like this: if the sales budget is 100,000 unit, the business most of the time want to produce a bit more, maybe 110,000 unit. Why the business want to produce more? Because they want to keep some inventory or stock. There are many benefits of keeping stocks. After the business prepare the production budget, or after the business know how many unit should be produced, the business can prepare the direct material budget, direct labor budget, and factory overhead budget. After that, so when there is a production budgeted quantity, the company or the business can calculate how many material they have to purchase, how many labor hours they have to ready, and then how many factory overhead they will have to pay. And then after that, with all the budget, direct material budget, direct labor budget, and factory overhead budget, the company can prepare cost of goods sold budget. Okay, after see here, the first step I have told you, the first step in preparing the master budget is prepare a sales budget. After a business has a sales budget, the business also can prepare the selling and admin expenses budget. Selling and admin expenses budget is also a budget that is depending on the sales budget or sales quantity. The higher the sales, the more the selling and admin expenses most of the time. So see here, with the when the business already has prepared the cost of goods sold budget and selling and admin expenses budget, the business can prepare the budgeted income statement. When the business prepare the budgeted income statement, the business can see how much profit they can make in the next budgeted year. That is a master budget. Very, very good. If you have a business in the future, you should prepare a master budget for your business because it covers everything. When a new year started, if you have a master budget, you know what to do. How many sales you have to achieve, how many production unit has to be made, how many material to be purchased, how many labors the business should have, etc. And then the business has clear picture about how much profit they can make if they achieve this much of sales. But the most important thing in this topic is you have to know about the first you have to know about the definition of the budget, and the second thing is you have to know the effect of budget on behavior of employees or workers or managers, and then you have to know about static budget and flexible budget. You have to know how to prepare a static budget, and also you have to know how to prepare a flexible budget. Okay, and I think also in this topic you also have to learn about how to prepare a performance report. I will share with you a video about performance report also. So this is the end of the lecture for this today. Do not forget to write your name and metric number in the comment section. I will take that as your lecture attendance. Thank you very much.